I'm Ray, a commercial real estate broker working with landlords, owners, and investors of strip centers here in Central and South Texas. What we focus on is property specific advisory, helping owners better understand what's happening in the market so they can make smarter decisions and ultimately improve returns. This retail weekend wrap up exists so that we can keep an eye on the U.S. consumer and retail so you can stay more informed without having to chase down the headlines. We'll start with what's happened in the past week when it comes to the economy and macroeconomic news. So first up, business activity is holding up, but hiring is on a pause. According to S&P Global's latest Purchasing Managers Index, PMI, U.S. business activity picked up slightly in January, hitting a 2-month high. That tells us the economy is still expanding, but it's doing so more slowly than it was last fall. Manufacturing improved modestly, with factories ramping up production to the highest level since August. However, new orders were weak and foreign demand dropped to its lowest level since April. The more important signal here is hiring. For the second month in a row, companies added barely any new employees. Businesses cited rising costs, soft sales, and uncertainty as reasons for holding back. Some also noted difficulty finding workers, possibly tied to tighter immigration policies, shrinking the labor pool. Tariffs are also back in the conversation, pushing up input costs, especially for manufacturers, and forcing some firms to raise prices to the highest level in 5 months. The economy isn't rolling over, but businesses are cautious. They're choosing productivity and cost control over headcount growth, which matters for wage growth, consumer confidence, and retail demand. Gold just hit a record price of over $5,000 an ounce, up 65% in 2025 alone. Gold tends to rally when people are nervous, and this time it's not just individual investors. Central banks around the world are buying gold instead of relying as heavily on the US dollar. Now we're asking why. Political uncertainty, rising debt levels, tariff threats, pressure on the Federal Reserve, and broader concerns about long-term currency stability. The Federal Reserve has also recently cut rates, but not this month. We'll get to that, which reduces returns on cash and makes gold more attractive as a store of value, even though it produces no yield. For everyday consumers, this shows up in higher jewelry prices, but zooming out, gold is being treated less like a luxury and more like insurance. When gold behaves like a safety blanket, it's a sign that confidence is fragile, even if spending hasn't collapsed yet. On to interest rates. They're likely staying higher for longer. At its January meeting, the Federal Reserve decided not to continue cutting rates, keeping the federal funds rate in the 3.5 to 3.25 range. After cutting rates by 75 basis points in the second half of 2025, policymakers believe the economy is in decent shape. Consumers are still spending, businesses are investing, and the job market looks stable enough that the Fed doesn't feel urgency to move further. At the same time, inflation hasn't cooled enough to justify aggressive cuts. Borrowing costs may stay elevated longer than many have hoped, and that matters directly for mortgages, credit cards, and very importantly, commercial real estate financing and refinancing decisions. According to this news release from the Bureau of Labor Statistics, labor productivity jumped nearly 5%, the fastest gain in 2 years. Businesses are producing more output with fewer hours worked, which pushed unit labor costs down almost 2%. That's great for corporate margins and helps explain why companies are comfortable slowing hiring. They don't need more people to grow, at least not yet. For workers, though, there's a trade-off. Pay hasn't kept up with productivity gains, meaning purchasing power slipped in the quarter. Efficiency is winning. Growth is coming from output per worker, not more workers, which reinforces why hiring feels sluggish even when layoffs are low. And speaking about layoffs, initial unemployment claims remain near multi year lows, and continuing claims just fell to their lowest level since September 2024. Hiring has stalled, but companies are not cutting workers aggressively. Job security is solid, but job searches are taking longer, and this supports steady consumer spending, but not a big surge. Moving into retail news, ICSC's latest outlook highlights something we've been seeing on the ground. Grocery anchored and neighborhood centers are the strongest retail assets they've been in nearly a decade, excluding malls. Key themes: transaction volume is expected to rise as sideline capital re enters the market, lenders are becoming more flexible, and significant capital is actively looking for stabilized retail deals. Quick takeaway for owners: quality strip centers are seeing stronger pricing support and improved liquidity. 2026 could be a very different market for sellers than the past 2 years. According to CoStar, store openings are exceeding closures early in 2026, with over 1,200 announced openings versus 733 closures so far. And this supports the idea that physical retail demand hasn't disappeared, it's becoming more selective. Well located community and neighborhood centers benefit the most. Jersey Mike's is reportedly exploring a public offering at a valuation around $12 billion. That's a powerful signal for retail real estate. QSR brands with strong unit economics, off premise sales, and disciplined site selection are attracting serious capital, even in a cautious consumer environment. Food remains one of the strongest traffic drivers in retail, but the winners are brands with operational discipline and repeat visitation, not just name recognition. Wanted to give a quick note on a partner of the channel, Share Scoops. They are an AI powered financial content platform built to help advisors and financial professionals communicate complex market and economic information in a way that's clear and approachable and consistent. And they help turn dense data into content that builds trust and engagement without spending hours each week writing or chasing headlines. If you're an advisor or broker looking to educate clients more efficiently, they've created a discounted sign up link for my audience in the description. So please check it out. Moving into the final segment of our retail weekend wrap up, and this is office hours for owners and investors of strip centers. In this segment, we've been talking about a lot of beliefs holding a lot of owners back. This week is a belief that treats leasing as a transaction and not a strategy. And what I want owners to consider is that strategic leasing builds value. Filling a vacancy is not the same as positioning a center. Two centers can be fully leased and perform very differently. One has the wrong tenant mix, weak traffic drivers, and capped rent growth, and the other is intentionally repositioned, supports cross shopping, and attracts better buyers. The difference isn't just management, it's advisory oversight, doing a financial analysis annually, market based leasing strategies, tenant mix optimization, and long term exit thinking. When leasing decisions align with positioning, cash flow improves and value follows. If you're starting to notice that leasing alone isn't moving the needle, that's not a problem, it's a signal. And that's this week's Retail Weekend Wrap Up. Thanks for joining me. If you need any help or want to talk about leasing strategy, positioning, or long term value for your property, or anything about retail real estate, feel free to reach out. You can find my information in the description. And until next time, make more money on your deals. Thanks.